Frequently asked questions. Multiple property exchanges. There are many scenarios where taxpayers may choose to exchange out of multiple relinquished properties and into one larger replacement property, or alternatively, exchange out of one relinquished property and into multiple replacement properties. What I want to do in this brief segment is walk through those two scenarios with what it looks like visually and then talk through some of the practical issues that might be involved. On this slide, you'll see the taxpayer up top. This taxpayer sold three relinquished properties, so three smaller relinquished properties. What they ultimately want to do is acquire one much larger replacement property. So this is an example of the strategy of consolidation, right? Consolidating from multiple properties into one larger property. So visually, what it looks like is the taxpayer goes ahead here, and we're going to have direct deeding to three separate buyers. The money comes to the qualified intermediary from each of those three sales. The intermediary takes all of that money and purchases one replacement property within 180 days, and then instructs the closing officer to directly deed that replacement property back to the taxpayer. So practical considerations. One thing to keep in mind if you're selling three relinquished properties as part of one exchange, not setting up separate exchanges for each of these three relinquished properties, there is an issue of having to follow the time deadlines that become a little more restrictive. Once property number one sells or closes, that triggers the 45 and 180-day time deadlines for the entire exchange. So when property one closes, the taxpayer has 45 days to identify the replacement property. They also have no more than 180 days to sell property 2 and to sell property 3. So if a taxpayer is going to consolidate like this, one practical suggestion, and again review this with your real estate agent or broker and or tax or legal advisors, might be to get property number 1 under contract, but push back the closing date. Then with properties 2 and 3, you might want to drop the listing price just a little bit to get them under contract to make sure that from a time standpoint you can accomplish everything within the 180-day exchange period. Now the next scenario of a multiple property exchange is one where a taxpayer sells one property to a buyer. So again, the qualified intermediary steps into the shoes. We sell the property to the buyer, instruct the closer to directly deed the property. We receive the money, and then the qualified intermediary is then going to be assigned into the purchase contracts for properties 1, 2, and 3. So we use that money to purchase the property and instruct the closing officer to directly deed it back. This is an example of diversification. So we're going to diversify. Property is sold, and we're going to exchange it into 3 separate replacement properties during the exchange time. So in this example, under the identification rules, the taxpayer is going to have to fall under either the 3-property identification rule, which applies in this scenario, the 200% identification rule, or the 95% identification rule. And they have a maximum of 180 days to complete the entire 1031 exchange. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.